Hello, everyone. Hello, everyone. If this is your first time here, welcome. To those who are returning, welcome back. If you have not already subscribed to my channel, would you do so? If you just hit that red subscribe button, I would really appreciate it. Today, we're continuing the discussion on student loans, and today's topic is student loan repayment plans. Now, last week, in the discussion around FAFSA, I neglected to mention that there is a deadline for applying for FAFSA, and you must also consider the deadline that your school has to receive your financial information. So you want to consider the deadlines for FAFSA, and you want to consider the deadline of your school, and you want to sync those up to ensure that you are completing the FAFSA information in time so your school can get that information to complete your financial loan package. So I just wanted to add that to last week's discussion. I am going to link last week's discussion to this video once YouTube releases it from the live stream. So to continue the discussion, two things I want you to think about while you're in school is the first is you are going to get a notification from your loan servicer, because once you apply through the FAFSA and your school give you that application packet, you are going to get information from the company that's going to service your loan. This company is a company that will manage your loan, any changes that you want to make in your repayment plan, any of that, payment dates, anything like that, this company will manage it. You may be familiar with the name Nelnet, Navient, Great Lakes. Those are some of the student loan servicers. So you're going to get an email once you get the first disbursement from your loan. And what you want to do is create an account. You don't want to wait until you've graduated to look at your account. You want to create an account on the loan servicer's website. And that allows you to be able to manage your account and all of the information around your account once that first disbursement comes through. Next week, I'm going to conclude this student loan discussion. And one of the things I'm going to talk about, and I'm going to show practical examples of what happens when you don't manage your student loan while you're in school and not wait to pay until the end of your student, your educational journey. Okay, so you're going to get the email from your loan servicer once your first disbursement goes through. Create your account so you can start managing your account. Now, 6 months after you've graduated, supposedly it's to give you the chance to get that good job, right? And to set up your bills and all of that. You're going to get a 6-month grace period at the end of after you've graduated, and that soon thereafter you are going to be required to start making payment. Now you are going to get an email with an amount. Don't panic, okay? You have control over what payment plan and how much you pay, pretty much. That first email is probably going to be based on the standard repayment plan. And I'm going to go through these. It's going to probably be based on the standard repayment plan because that is the base. And all the plans that I'll talk about afterwards are going to be a deviation from the standard repayment plan. So we'll go through that in a little bit. So just be aware of that email that you're going to get from your loan servicer. Pay attention to it. Create your account. Manage your account while you're in school. 6 months after you've graduated, it's going to be time to start paying. And so I created a document and I wanted to share it. This way, when you go back and you review the video, you're able to put the information that I'm sharing with the actual document and be able to reference the document, and then you'll be able to reference the studentaid.gov website. Hi everyone. Hi Maya, Talisha, Alicia, and Mukbang, that thing. Thank you for joining. Hi everyone. Okay, so what you're going to do is you are going to go to the studentaid.gov website and you are going to play with the numbers. By that I mean you're going to go into what's called the loan simulator. You're going to put your information in. They will ask you for different things. Well, do you want to pay off first, or do you want to pay fast, or do you want a shorter period, or do you want to pay less, which means you're going to manage your interest rate on the loans. So they will ask you a series of questions, and that will help select what payment plans you qualify for. And based on that, you'll be able to choose the one that is more palatable to you. So I'm going to go ahead and share. Hi, Nadia. I'm going to go ahead and share my screen, which will bring up my document. And let me know that you can see my screen. Can you see the document? All right, I'm not getting a response. I'm going to assume that everyone can see the document. So I'm going to start off by talking about the loan types. Now, direct subsidized loans, those are only issued to students with financial needs, and that's only undergrads. So students with financial need that are in undergraduate programs, those are the ones that qualify for the direct subsidized loans. Direct unsubsidized loans, there is no financial need. Qualification is not based on financial need, but the ones who can get that loan is parents of undergrad and graduate students and professional students, meaning you're pursuing a doctorate or a law degree or something like that. So you will qualify for the direct unsubsidized loan. And as I explained in the video last week, subsidized simply means that the government pays the interest while you're in school. Unsubsidized means the interest begins to accrue from the first day the loan is issued. And again, next week I'll show you the numbers, and maybe that will scare you. I didn't know anything about all of that, which is why I'm sharing this information, because I'm trying to use what I learned and the mistakes that I make to educate others so they don't make the mistakes that I did. So that will, on the unsubsidized loans, the interest rate continues to accrue daily, and at the end of your college years, then all of that interest will be added to the base and it becomes your new base. So you're paying interest on top of interest. Okay, the next set of loans is the Direct Plus, and this is where parents can get the Direct Plus parent loan. They can borrow on behalf of their kids, and for there will be a credit check. So there is no financial need attached to the Direct Plus loan, but you will have to undergo a credit check because they're trying to see how creditworthy you are. How are you going to be able to pay that loan back? So that is parents of undergrad that can apply for those. Students or graduate students or professional students. So again, the three main ones: direct subsidized, it's based on financial need, undergrad qualifies; direct unsubsidized, It's not financial need. All levels qualify for that. And I think I said before that parents of undergrad qualify, but really all levels of education qualifies for the direct unsubsidized, whether you're undergrad, grad, or professional. The direct plus is where the parents of undergrad can ask for that loan, and then grad and professional students will qualify for those loans. And then the direct consolidation loans, this just is an amalgamation of any of those loans. Maybe in undergrad you got the subsidized loans and your servicer was Nelnet, and maybe in grad you got the another set of loans and your servicer is Great Lakes. So now you're thinking, instead of me paying two different servicers, I want to pay one servicer. And so you might want to consider consolidating your loans. Now, there are pros and cons to that, and I discussed that in a prior video, which I will also reference when YouTube releases this video. Now, the other two loans are loans that I will reference as I go through the different payment plans, but they are no longer in play. They expired. The federal family education loan expired in 2010. And the federal Perkins loan expired in 2017. But I wanted to put them on there because some of the payment plans, you will still qualify if you had those loans at the time. Okay, so let's move right along and discuss the payment plans. The first one is the standard payment plan. All borrowers are eligible for this loan, whether you are parent, student, grad, undergrad, all borrowers qualify for this payment plan. The loans that qualify are direct subsidized and unsubsidized. And I have here federal Stafford loans, subsidized and unsubsidized, for those who may have gotten those loans before, because those loans are now considered direct subsidized and unsubsidized. But I wanted to include that and put it in italics, because if you're not familiar with direct subsidized and unsubsidized, and maybe your loan was called federal Stafford loans, then you still qualify, even though it's no longer called federal Stafford loans. Okay, hope that makes sense. And of course, the direct plus loans, consolidation loans. Now, this one, you're going to pay. This one typically is you pay the most throughout the loan, because it's a fixed amount that's paid within 10 years. So the amount pretty much doesn't change. They calculate what you would pay in 10 years based on your interest and all of that, and you have a fixed amount. Now, of course, you can pay ahead of time. There is no penalty. You can change your plans. There is no penalty, and you can pay before the 10 years. This loan does not, repayment plan does not qualify for the PSLF. So if you are thinking that you want to pursue the public service loan forgiveness program, this is not the payment plan that you want to choose. So I hope that makes sense. Let me check in the comments if we have any questions so far. All right, I don't see any, so let's continue. All right, so the next payment plan is the graduated payment plan. And as the name suggests, you're going to start with a small amount and you're going to gradually increase your payment, and everything will be paid within 10 years. So even if you start small and gradually increase to a higher amount, you will still be required to pay everything within 10 years. Now, if you've consolidated your loan, the period that you're required to pay is between 10 to 30 years. And again, this repayment plan does not qualify you for the PSLF. So if you are thinking of that, just cross this plan off of your list. Because even if the payment amounts are attractive to you and you are wanting to get loan forgiveness, it doesn't make sense to get on a plan that is not conducive to getting that forgiveness. So number 3 is the extended payment plan. This one, you have to owe more than $30,000 in direct loans. And the loans that qualify are listed right there: direct subsidized, unsubsidized, etc. Now, this could be a fixed or graduated payment. It depends on when you got your first disbursement in your loan. So you could end up paying fixed amount over, and really you are required to pay this within 25 years. Or you could end up with the graduated payment plan. And again, this payment plan does not qualify for public service loan forgiveness. So if you owe less than $30,000 in direct loans, whether it's direct subsidized, unsubsidized, the formerly named federal Stafford loans, direct plus loan, if you have less than $30,000, this plan will not work for you. Okay, so you can cross that one off of your list. Now, the next one is one of the most popular, and that's because it's based on your income. And so if your income is, say, $60,000 this year, and then you lose that job and you get a job for making $40,000, the next year when you recertify, you're going to be able to pay less. Okay, the borrowers that are eligible for this one is all borrowers with direct loan types. So direct subsidized and direct unsubsidized, direct plus. Only direct plus made to students. Direct plus parent loans do not qualify for the repay plan. Typically, the amount that you're going to pay is 10% of your discretionary income, and discretionary income is income after you've taken care of the basics. Well, let me back up. Discretionary income is calculated differently by different industries. For your student loans, it's income, it's what's left after you've paid taxes and you've taken care of home, food, and shelter. That's pretty much what discretionary here means here. The loan balances will be forgiven if after 20 years, if you're undergraduate and you have not paid off all of the loan, after 20 years, the loan will be forgiven. If you're a graduate student or a professional student and you've not paid the balances in full after 25 years, then the loan will be forgiven. Now, I don't know who wants to have a loan going 20 or 25 years. I want to get rid of that thing, okay? There are income tax implications. If the loans have been forgiven, then there's a possibility that you could end up paying income tax. So you want to consider that. Now, another thing to consider is your spouse's income and debt load will be considered when you go through the recertification process, or when you do the first application for this loan, when you apply to be covered under this loan. Your spouse's income and debt load will be considered, and you don't even have to file a joint return. As long as you're married, their income is going to be considered. Okay, and this one does qualify for the public service loan forgiveness. So typically the longer loans are considered or qualifies for the public service loan forgiveness plan. So you might want to consider that. It's a trade-off. It's do I pay more and a bigger amount and get rid of that loan, or do I pay a smaller amount but extend the period that I pay and then be qualified for the PSLF? So you got to kind of weigh what it is, what your goal is, and what it is that you're trying to achieve. Okay. Now, yeah, Alicia, thank you. You may want to check out the video from last week, because that talks about the beginning of the process and what you need to consider as you apply for college, and the things that you need to have in hand when you apply for student loans. Okay, so this is for the repay loan, And this is the one that I decided to take out, to apply for. And here is why I did. I'll share a little bit of my story, because next week I'm really going to share my story in full as to what I've done to pay down my loan as much as I have. But here is why I did the repay. When I first got my notice from Nelnet, who is my loan servicer, the amount they wanted me to pay was about $1,600. Could I pay it? Could I afford it? Yes. But what was going to happen is it was going to cause me to have a tight budget. I had just gone through a divorce. I'm the parent of one child who's getting ready to go to college. At that time, was in a couple of years was getting ready to go to college. So I had to weigh, do I pay this because I can afford it, or do I want to give myself some wiggle room? So I decided to use this plan. And what I ended up doing is, even though this plan is maybe a third, I think it was a third or a fourth of what I was required to pay under the standard plan, I'm still paying the $16,000 to $2,000 per month. And the reason I'm doing that is because I control how much I pay. And I'm going to talk a little bit next week about the strategy to make sure that I don't have accrued interest on any of my loans. But I chose this because I now control how much I pay. So if something were to happen, I have wiggle room in my budget, and I'm not going to default because my budget was so tight. So, again, you have to think about things like this. It's not a matter of can I afford it, but how much wiggle room does it give you, and how much can you better manage your payments if you have a lower amount, but you can still pay more than what they are telling you to pay to be able to cover the interest payments and not have accrued interest. But if anything were to happen, you still can say, hey, that's okay. I can go back to my original amount and I can pay that. So this is what I like about this repay plan. And of course, it does qualify for the public service loan forgiveness. Based on the industry I'm in and the job I do not qualify for the public service loan forgiveness program. So even though it qualifies me, the plan qualifies me, but my job does not qualify me. And again, next week we'll talk some more about that. So let me check. Do we have any more questions or comments? Let's see. Okay, no more. Thank you, DNC Nation. All right, so the next one is, and there are 7 in total. There are 7 income repayment plans. The next one is the income-based repayment plan, and there are a little bit more nuance around this plan. So for this one, your debt to income ratio must be high. Now, I looked through the website, and what do you mean by high? They never qualified what they meant, but I did find an article that talked about your income being, I think, 150% lower than the poverty line, or the income, because everybody falls into a certain income range based on the poverty line. If you're only a single person, if you have 2 persons in the family, if you have 3, 4, there's a certain range that you fall into, and they look at that to see, are you above and below that range, to determine if you are above and below or below the poverty line. So debt to income ratio must be high. I am thinking, okay, it's got to be me 30-50% is what I'm thinking. But I think when you go into the calculator, I did not qualify for this one, so I couldn't put my numbers would not pop up for me to use as an example to be able to tell you what that meant. But the loans that qualify for the income-based repayment plan are the direct subsidized and unsubsidized, which is a standard. The federal Stafford loan, subsidized and unsubsidized, which again, it's been changed to the direct. But for those who had those loans, this is what it is. The Direct Plus loans only for students. The Direct Plus parent loans do not qualify for this plan. And then the consolidation loans, This is where you can consolidate your direct or your federal family education loan, which of course I mentioned up front that that one expired in 2010, sorry, and is no longer available. But if you had that at the time, then you can qualify for the income-based repayment plan. But none of your parent loans will qualify for this plan. And the amount that you typically pay is 10 to 15% of your discretionary income. Loan balances will be forgiven after 20 years if you were in an undergrad program, 25 years if in a graduate program. But again, I do not want my loan to be hanging around. I'm going to do whatever I can, and I'm going to share again all the things that I did and I'm doing to knock out my student loans, because I do not want that thing dragging on 25 years. Okay, and then income tax implications. If the loan is forgiven, then you may be assessed income tax on that forgiven amount. There is a recertification process each year, and only if you filed a joint return will your spouse's information be considered on the income-based repayment plan. So if you're married and you filed separately, your spouse's income and debt load will not be considered on the income-based repayment plan. So that's something to think about. This plan does qualify for the Public Service Loan Forgiveness Program. All right, number 6, the Income Contingent Repayment Plan. Now, anything with the government is not going to be simple, right? They're going to create and levels and levels and levels. So we know we have to deal with it. So if we know the rules of the game, we can play the game. That is just my thing. Is if we know the rules of the game for credit, we can play the game. If we know the rules of the game for student loans, we can play the game. If we know the rules of the game for banking, saving, all of that, if we know the rules, we can play the game. But we have to know the rules, right? So income contingent repayment plan, again, this borrowers with direct loan types, which are listed below, would qualify. The payment amount is the lesser of 20% or fixed payments over a 12-year plan. And that means they'll take 20% of your loan, and they'll take the fixed payments over a 12-year plan. So whatever it is, they'll divide it by 12, and whichever is less is what you would pay for this income contingent repayment plan. The same applies with the loan balances, except now loan balances will be forgiven after 25 years, and of course the income tax implications. Again, the recertification process, or when you apply, spouse's income and debt load will only be considered if you filed a joint return. And Parent Plus, before I talked about the Parent Plus, that a lot of the Direct Plus loans that parents wouldn't qualify for them. For this one, if the parent decides to consolidate into a regular consolidated Direct Plus loan, then they would qualify for this income contingent repayment plan. So pretty much the government punishes parents for borrowing on behalf of their kids, pretty much. This payment plan qualifies for public service loan forgiveness, because these latter repayment plans that I talk about, they're typically higher, and the interest rates for the Parent Plus loans are typically higher than the other loans. So you're, as a parent borrowing for your student, you're punished, which doesn't make sense to me, but what do I know? What do I know? All right, so number 7 is the last one, and this one is the income sensitive repayment plan. Now, this one only applies to the federal family education loan plan, and I don't think I explained what that plan was before. The federal family education loan, that was where you would borrow money directly from banks, but it was based on it was with the government's permission or the government's sign off, because the government would underwrite those loans, but instead of getting the loans from the government, you're getting the loans from the banks. So that program expired in 2010, and they did not bring it back. So the FFEL plus loans, FFEL consolidation loans, and at the time, federal Stafford loans and unsubsidized loans, those would qualify under the income sensitive repayment plan. And the payment, how you pay back, is based on your annual income, and you're going to be paying within 15 years. And the formula to calculate that payment is going to vary by lender. And that's, again, because the banks were the lender. The loan was just underwritten by the government. And this payment plan does not qualify for the public service loan forgiveness program. So typically, loans 10 and under do not qualify. And then, of course, this one, because it was managed by the banks, does not qualify. But typically, loans over 10 years will qualify for the public service loan forgiveness program. All right, so I'm going to stop sharing now and see if you have any questions.